As of 2024, institutional digital asset custody has become a substantial and increasingly standardized financial services sector. Coinbase Custody Trust, the qualified custodian subsidiary of Coinbase, alone holds over $100 billion in institutional assets. BitGo, the multi-signature custody specialist, secures over $60 billion. Anchorage Digital, the only federally chartered digital asset bank in the United States, holds tens of billions more. Combined with emerging entrants from traditional financial institutions, Fidelity Digital Assets, State Street's Institutional Custody Partnership, BNY Mellon's Digital Asset Division, the institutional custody infrastructure now exceeds $300 billion in secured assets. For portfolio managers, family office CIOs, and RIAs who must make custody decisions as part of any institutional crypto allocation, understanding how these custodians actually work, the cryptographic architectures, the operational controls, the insurance mechanisms, and the governance frameworks is not optional due diligence. It is the foundation of sound fiduciary practice. This video provides a technical but accessible deep dive into the mechanics of institutional crypto custody. Two architectural approaches dominate institutional crypto custody, each with distinct security and operational properties. Multi-party computation, or MPC, is the most sophisticated approach and the one adopted by Coinbase Prime, Anchorage, and most new-generation custodians. The concept is mathematically elegant. The private key that controls the digital assets is never created as a complete object anywhere. Instead, cryptographic shares are generated across multiple independent secure environments. A threshold signature scheme requires a specified number of shares to participate in signing, without any single location ever holding a reconstructed complete key. This eliminates the most dangerous single point of failure in traditional key management, the moment when the key exists as a complete object and is therefore maximally vulnerable. Multi-signature custody, used by BitGo and as the legacy standard, takes a different approach. Multiple independent, complete private keys are generated and distributed to separate custodians, the client, the custodian, and a backup key holder. Any transaction requires signatures from a specified threshold of these key holders, typically 2 of 3. Multi-SIG is more transparent than MPC. Each individual key can be independently verified to exist and is individually auditable, making it simpler for legal and compliance teams to understand the custody arrangement. Hardware security modules are the physical security foundation of both approaches. HSMs are tamper-resistant hardware devices certified to FIPS 140-2 Level 3 standards, meaning they are designed to destroy key material if physically tampered with. Understanding how an institutional withdrawal actually flows through the Coinbase Prime system illustrates the operational controls that distinguish qualified institutional custody from retail exchange withdrawals. Step 1. A withdrawal request is submitted through the Prime client portal by an authorized institution user. The portal enforces address whitelisting. The destination address must have been pre-approved through a separate workflow, typically requiring multi-approver sign-off during the initial whitelist setup. Any attempt to send assets to a non-whitelist address is rejected at the request stage, before any signing occurs. Step 2. The withdrawal request enters a multi-approver review queue. The institution's own designated signatories, typically requiring 2 of 3 or 3 of 5 approvals depending on the institution's configured policy, must review and approve the request. Coinbase applies its own independent monitoring and anomaly detection layer as an additional check. Step 3. A configurable time lock period begins. For large institutional withdrawals, institutions configure delays of 4 to 24 hours, providing a final window to detect and cancel fraudulent or erroneous requests before they execute. Automated monitoring systems flag unusual patterns, unexpected amounts, novel destination addresses, or FOUS requests for human review. Step 4. Upon clearing all approval and monitoring gates, the transaction is signed using Coinbase's MPC infrastructure, distributed across geographically separate secure facilities, and broadcast to the blockchain network. The entire signing ceremony is logged with cryptographic verification for audit purposes. Coinbase Prime has evolved from a pure custody product into a full-service institutional platform that provides an integrated suite of services through a single counterparty relationship. At the center is qualified custody, holding digital assets through the Coinbase Custody Trust entity, with New York Trust Charter, SOC 2 Type 2 certification, and Lloyd's of London insurance coverage. Prime brokerage services, including OTC execution, algorithmic trading, and access to Coinbase exchange liquidity, allow institutions to execute large block trades with minimal market impact through the same platform where assets are custodied. Ethereum staking through Coinbase Prime enables institutions to earn approximately 3 to 5% APY on custodied ETH, with the staked ETH remaining in qualified custody and staking rewards distributed directly to the custody account. Reporting infrastructure provides portfolio analytics, transaction cost analysis, and tax-optimized reporting data compatible with standard institutional accounting systems. Credit facilities allow institutions to borrow against custodied Bitcoin and Ethereum positions, enabling treasury management without triggering taxable disposal events. The integrated nature of these services, all within a single qualified custodian relationship, is the primary value proposition of the Prime platform for institutions seeking to minimize the number of regulated counterparty relationships required for a complete crypto operational infrastructure. The Coinbase Prime versus BitGo comparison at the technical level reveals meaningful architectural differences that drive custody selection for different institutional requirements. Coinbase Prime uses MPC custody. No complete private key ever exists in any single location. The key shares are distributed across multiple geographic locations in AWS-hosted hardware security modules, and the threshold signature requires shares from multiple independent secure locations to participate in signing. This architecture eliminates single points of compromise. From an audit perspective, MPC's transparency is lower than multi-SIG. The key shares are mathematical objects that cannot be individually verified in the way a traditional private key can. BitGo's multi-signature architecture is more legible to traditional legal and compliance frameworks. A 2 of 3 multi-SIG arrangement has 3 independently verifiable private keys held in 3 separate custody arrangements, one by the institution, one by BitGo, and one by a designated backup custodian. Each key's existence and control can be independently confirmed through standard cryptographic verification. This transparency is particularly valued by institutional legal teams conducting custody due diligence. BitGo's 150-plus asset coverage significantly exceeds Coinbase's 40-plus major assets, making it the preferred custodian for institutions holding a broader range of digital assets beyond Bitcoin and Ethereum. Both custodians carry comparable insurance coverage from Lloyd's of London syndicates and publish SOC 2 Type 2 reports from Big Four auditors. Understanding the all-in cost structure of institutional custody is essential for accurate fee budgeting and custodian comparison. Custody fees, the core service charge for securing and holding assets, typically range from 0.05% to 0.15% annually on assets under custody, with fee compression occurring at larger AUM levels through negotiated agreements. Trading fees for OTC execution through the prime brokerage channel typically run 0.05 to 0.2% per transaction, significantly above ETF bid-ask spreads but inclusive of concierge execution for large block trades. Blockchain network fees, gas costs for on-chain withdrawal transactions, are variable and determined by network congestion rather than custodian pricing. For Bitcoin, a withdrawal typically costs $15 to $50 at current fee levels. Staking commission is an additional cost layer for institutions utilizing custody-integrated staking. Custodians typically retain 10 to 25% of gross staking rewards as commission for the service. On a 4% Ethereum staking yield with a 20% commission, the net yield to the institution is 3.2%. Working through a concrete example, a $50 million Bitcoin portfolio plus a $10 million Ethereum portfolio, with moderate trading activity, would incur approximately $170,000 in all-in annual custody costs, approximately 0.28% of AUM. This compares favorably to comparable infrastructure costs in other alternative asset classes. 5 decision criteria for institutional custody selection. 1. Confirm qualified custodian status independently. Contact the relevant state regulatory body or the OCC to verify current, active status, not the custodian's marketing materials. The legal implications of using a non-qualified custodian for investment advisor mandates are severe. 2. Choose between MPC and multi-SIG based on your governance framework. Both are institutionally appropriate. MPC provides superior mathematical security. Multi-SIG provides superior audit transparency. Neither is universally superior. The choice should reflect your compliance and legal team's comfort level with each architecture. 3. Read the insurance policy directly. Understand per occurrence limits. A $320 million aggregate limit means a $500 million loss event leaves $180 million uncovered. Know whether hot wallet balances are covered separately from cold storage. 4. Negotiate fee agreements. Standard rate cards are starting points. Institutions allocating $25 million or more with multi-year commitments have meaningful negotiating leverage for fee reductions of 20 to 50% below published rates. 5. Never assume controls are configured correctly without testing. Before transferring institutional assets, execute the complete withdrawal workflow with a nominal test amount. Verify that address whitelisting prevents non-whitelist destinations, that multi-approver requirements function as configured, and that time-lock delays are enforced. Custody infrastructure is the foundation that every institutional crypto strategy is built on, and getting it right requires understanding the mechanics, not just the marketing. Crypto Mechanics provides exactly this level of analytical depth for professional investors. Subscribe now for the institutional-grade analysis that makes digital asset allocation decisions defensible.